Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Angang Steel Company Limited annual report. Angang Steel Company Limited offers a diverse range of businesses and services across various industries. The company's primary products include steel sheets, seamless steel pipes, wire rods, heavy rails, profiles, cold-rolled silicon steel, and galvanized steel sheets. In addition to production and sale of these products, the company also engages in ferrous metal smelting and steel rolling processing activities. The company provides a wide range of services, including e-commerce transactions of industrial products, consulting and logistics distribution technology services, sales of equipment for gas and liquid separation and purification, supply chain financial services, and steel trade activities. Angang Steel Company Limited also offers various other services such as the sale of compressed and liquefied gas, coal chemical, coking and chemical products, and dissolved acetylene. Furthermore, the company is involved in metal materials and product sales, building material sales, imports, exports, wholesales, and retailing of steel and goods. Its products are used in various industries including machinery, metallurgy, petroleum, chemical, coal, electricity, railway, ship, automobile, construction, home appliances, and aviation. With a presence in both domestic and international markets, Angang Steel Company Limited has established itself as a leading player in the steel industry. Angang Steel Company Limited market capitalization of 20 billion is significantly larger than the average industry peer of roughly 0 billion. This shows that Angang Steel Company Limited holds a significant advantage in their industry. Angang Steel Company Limited trades at a lower price-to-book ratio of 0.27 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On one hand, revenue decline is primarily driven by a decrease in production volumes, sales, operating income, and prime operating revenue. Specifically, the decline in iron, crude steel, and steel products production volumes has contributed to the revenue downturn. On the other hand, revenue growth is driven by several key drivers. These include increased market share in low-temperature liquid markets, improved contract execution rates, and enhanced export shipment volumes. Additionally, the company's focus on product premiumization, sales growth in medium and heavy plates, and large-scale application of green steel products have also contributed to revenue growth. Furthermore, the company has implemented various initiatives to drive revenue growth, including integration of sales, R&D, production, and finance, enhanced technical marketing service teams, digital intelligence development pathways, and standardization, automation, digitalization, and intelligent upgrades in key processes. These efforts are expected to continue driving revenue growth in the future. The net income of the company underwent a significant change in recent years. Initially, it decreased by 43% from -7,122 million RMB to -4,068 million RMB. However, upon closer inspection, we see that there was also an increase of RMB 3.054 billion year-on-year. This seeming contradiction can be attributed to the fact that the decrease is a percentage change, while the increase is in absolute terms. In terms of profit margins, the company experienced a remarkable turnaround. The operating income margin increased from -8.61% to 42.88%, and the net profit margin rose from -44.65% to 42.82%. These improvements indicate that the company has successfully managed its costs and improved its bottom line. However, it's worth noting that there was also a decrease of -8.61% year-over-year, suggesting that the company still faces challenges in maintaining consistency. The company's financial performance is a notable aspect of its overall health. A key indicator of this is the generation of positive operating cash flow. According to the provided summary, there are multiple confirmations of this trend. On page 35, it is stated that net cash flow from operating activities, plus RM 1,788 million, which clearly indicates a positive operating cash flow. This statement is further reinforced on page 36 with an identical figure, solidifying the company's ability to generate cash from its core operations. The confirmation of positive operating cash flow is also explicitly stated on page 39 as positive operating cash flow. Yes, this unequivocal declaration underscores the company's financial stability and capacity to manage its resources effectively. The company's debt level and interest expenses have undergone some changes in recent years. While the total borrowings remain unchanged at RMB 14,737 million, long-term borrowings have seen an increase from RMB 21,419 million to RMB 23,819 million between 2024 and 2025. In terms of interest expenses, there has been a notable increase. Interest expenses for 2024 were $285 million, but this figure rose to $332 million in the subsequent year. Additionally, interest expense also saw an increase by 9% from $310 to $337. These changes indicate that the company's debt obligations have become more costly over time. Management is emphasizing the importance of reform and efficiency enhancement in the company's outlook. This involves concentrating on quality and efficiency gains to solidify an operation-oriented enterprise. To achieve this, management plans to strengthen the value chain by improving profitability and production line efficiency. Additionally, the company aims to refine its cost chain through lean management and cost reduction. This will be achieved by optimizing the operational chain through intensive and efficient production. Furthermore, management is committed to solidifying the management chain through legal compliance and risk prevention. The ultimate goal of these efforts is to establish a model enterprise that excels in service quality. To achieve this, employee development and well-being are crucial. Management plans to strengthen the role of employees as the main force for development synergy and uphold the principle of sharing development achievements to enhance their overall well-being. The company's financial records indicate that it has a history of paying dividends. Although an initial review on page 8 suggests otherwise, closer examination reveals evidence to the contrary. A liability for unpaid dividends mentioned on page 68 implies that the company has indeed paid dividends in previous periods. Furthermore, page 78 explicitly states distribution of cash dividend this period, confirming that the company distributes cash dividends. Concerns about inventory buildup and supply chain disruption are evident in the company's financial performance. The hot-rolled sheets products division has seen a significant decline in operating income, accompanied by an increase in operating costs and a decrease in gross profit margin. Furthermore, the company has incurred substantial impairment losses on assets due to provision for inventory write-downs, totaling -348 million. This suggests that the company's inventory levels are higher than expected, leading to concerns about potential inventory buildup. Additionally, there are indications of supply chain disruption. 3 major suppliers have experienced significant issues, and Shanzhongyu Tianbao Steel Pipe Co., Limited, has a 100% bad debt provision. Shanghai Junsheng Supply Chain Management Co., Limited, also has a 100% bad debt provision, and Dongfeng Macheng Dalian Punching and Welding Parts Co., Limited, is bankrupt. The company's sales have also declined in the others product category by -20.18%, while operating income has decreased year-on-year, implying an increase in inventory levels. These factors collectively raise concerns about the potential for supply chain disruption and inventory buildup. That concludes the financial summary for Angang Steel Company Limited. Feel free to comment below, and I will be happy to answer them when possible.